What's up, everybody? Josh Bennett with Money Masters. In this video, we're going to talk about basically 5 different tax deductions that you, and especially if you're a business owner, can use to basically minimize your tax bill, which who doesn't want to minimize their tax bill? So one of the first tax breaks you can get is what is called the Augusta rule. So the Augusta rule is a tax loophole that can basically allow you to rent out your own home to your business for up to 14 days a year. So let's say hypothetically that you have a team with your business and you're wanting to do a team gathering event or a conference or education and some team building, whatever the case may be, and you're going to rent out a conference room or something just to gather everybody. Well, you find out that a conference room runs about $1,000 a day. Well, what you can do instead is you can rent out your own home for that same fair market value of about $1,000 a day, and you do that 14 times a year. That's now $14,000 deduction. So that could easily save you, $5,000-$6,000 in taxes right there just from doing that Augusta rule. So the Augusta rule again allows you to basically rent out your own home to your business for up to 14 days per year at a fair market value. So great tax loophole, especially if you have a business. Another big tax loophole if you're in the market for a car, especially an SUV, is what's called the Section 179 deduction. So this is a tax rule that's going to be in effect till about the end of 2022. But basically what it is and it may be still in effect in some way, shape, or form post 2022, excuse me. But to get the full measure as of right now, that's when you kind of act on this. But basically what it allows you to do, if you own a business, it allows you to deduct the purchase cost of a vehicle in the first year of purchase. So there's what's called bonus depreciation going on right now through 2022. But when you buy a SUV, and the key factor here is it has to be $6,000 or more, you can actually write off the cost of that purchase all in the first year. And to give you an idea of some of the cars that are 6,000 pounds, would be like a Jeep Grand Cherokee, a Ford F-150, some of these like trucks, SUVs. Those are going to be the ones that you can ultimately deduct. And between the costs or the deductions just allowed with purchasing a SUV vehicle, which is about $25,000, you combine that with bonus depreciation, you can end up writing off about $100,000, 100% of the cost of that purchase. It can't exceed the income of your business, so you can't go negative with that deduction. But if you made $100,000 and you bought a $100,000 car, well, guess what? You now have zero taxes. So that's a really powerful deduction right there. Another thing is just for a business owner especially, maximizing deductions in general. So this is something that I see all the time that business owners don't do. And tracking is going to be your best friend, just because the more you track, the more you can take advantage of every different business deduction out there. So for example, like if you work from a home office, make sure you're writing off the square footage of that dedicated home office space. Write off things like utilities, cell phone bills, any percentage of that bill that you use for business purposes, you want to track and make sure that you're writing that off to the full potential. Same with if you have a personal vehicle that you end up using for business use, make sure you're tracking those miles, so on and so forth. So make sure you're capturing and tracking every single deduction you can take as a business owner, because that's just going to ultimately lower your tax bill. And there's a lot of deductions out there. But be as creative as you can and kind of think through all the different expenses that are attached to your business in some way, shape, or form. So another one, this is more for business owners and for personal individuals, is a Roth IRA. So a Roth IRA is an often underutilized retirement savings vehicle, but how it works is your traditional 401ks, your traditional IRAs, when you put money into them, you get a tax deduction in the year that you put it in, which is why a lot of people like them, is because you pay less taxes today. But what happens is that money grows and grows and grows. It compounds over decades. And then when you take that money out in retirement, you pay taxes on it. And so if you're paying taxes on it in retirement, you're actually going to be paying a much larger tax bill because the money has grown. Roth IRA works the exact opposite. You can put up to $6,000 in it today, and it's after-tax dollars, meaning you've already paid the taxes on it. And as long as you follow the rules of the Roth IRA, you're never going to pay taxes on that money again. So it's a great way to pay a little bit of tax today for a overall long-term cost savings. And I'll record another video of this later on, but just the way our government and policies are going with the amount of debt we have in our country, the mathematical likelihood of tax rates going up is almost a foregone conclusion. So the more money you can get into tax-free, the better. And one last tax deduction for, and this is great if you have kids and are a business owner, is hiring your kids in the business. So most people don't hire their kids because they think they don't want to violate child labor laws and things like that, which is understandable. If you work with toxic materials or hazardous waste or things like that, you probably don't want to hire your kids. But if you have a clerk job or a business that requires admin work or data entry, something that your 8-year-old can do, well, if you have a job where your 8-year-old can do it, then you can hire them into there. There's no age restrictions for family when it comes to child labor laws. So you can hire them into your business. You can pay them up to $12,000 a year, which is the standard deduction, and they're not going to have any tax. So your child's not going to have any tax on their income. You get that money off of your business books as a deduction or an expense for wages. And so, say you have 2-3 kids, well, now you have $36,000, which could be, depending on your tax rate, could be a $10,000, $20,000 tax savings. So you can really add up the tax savings and teach your kids some valuable life lessons, get some potentially cheaper labor to help with your business. There's a lot of benefits of hiring your kids just in your business, not just from a tax perspective, but tax perspective is obviously a nice one to have in there. So hopefully you found these deductions valuable and these kind of tax tips and tricks that you can use useful, and hopefully, especially if you're a business owner, start applying these kind of through the year 2021 and beyond. But yeah, make sure you subscribe and like to this channel because we're going to throw a lot of different tax loopholes, write-offs, all that fun stuff your way, especially here over the coming months during tax season. But again, hope you found this valuable. Until next time, cheers.